A common misconception for a lot of buyers is that if a bank is willing to loan you money to purchase a commercial building, that technically, from the bank's perspective, it's considered low risk for both the buyer and also for the bank. But is that really a truthful statement? And the answer is no. Today, I'm going to break it down. All right, first and foremost, when it comes to banks, their loan approval is going to be based off of their guidelines and their overlays. And as long as the deal looks good on paper, yes, they'll move forward and do the deal. But something you got to keep in mind, they are not responsible for the riskiness of the future. So they're not responsible for the flexibility of that asset in the future. And they're also not responsible for your financial well-being in the future. Keep that in mind. Something else that often gets overlooked is equity position. You got to be careful with this, because if you have low equity, it definitely minimizes your opportunities. For example, if a property is heavily leveraged, everything starts to get more sensitive. I'm talking about interest rates, vacancies, repairs, market shifts. The truth is, less equity equals less opportunities. And what I mean by that is having low equity could technically make simple things like refinancing, selling, or holding a property extremely stressful and cumbersome. And this is exactly why my savviest investors are not just hyper concerned on getting an approval through a bank, they're actually more hyper concerned on the numbers, how much cushion they're going to have once the entire deal's done. All right, so here's my take on it. Whether a bank's willing to do the deal or not, it doesn't really matter. It's more so on your specific terms. If you feel that you're going to be over leveraged, don't do the deal.